Welcome. I'm Prabhat Ranjan. I'm co-fund manager here at 𝐼𝐻𝐻 PMS. So today I'm going to discuss about super value, which is a mid and small cap strategy here that we run here at 𝐼𝐻𝐻 PMS. But before that, just a quick background about myself. So I'm an engineer by trade. I have done my masters from Delhi School of Economics. I'm a CFA chartered holder, and I have more than 7 years of experience in the Indian equities market. So starting with the philosophy, how we manage the fund here at 𝐼𝐻𝐻. So we try to deliver a superior risk-adjusted return. What we mean by delivering superior risk-adjusted return is that we try to create a portfolio which can sufficiently outperform the benchmark over next 3 to 5 year time frame, delivering the higher earnings growth. So when we have a period where we deliver higher earnings growth with lesser volatility versus the benchmark, typically translates also into the stock price outperforming the benchmark over 3 to 5 year time frame. We have a multi-bagger framework here at 𝐼𝐻𝐻 that we employ to pick out businesses which can deliver superior returns over the benchmark. So in this multi-bagger framework, we have one growth leg, the other leg is value. We don't buy the businesses at any valuation, neither do we buy value traps in the portfolio. So mainly we try to find out the companies which can deliver, which can double the earnings over next 3 to 5 year time frame. And also we try to buy companies which trade at a discount with respect to the industry peers and also trade at a discount to the market leaders. So typically companies that we buy trades at a multiple of 15 to 25 P, and also if we put that into comparison with the benchmark, so the benchmark trades somewhere around 50 multiple, 50 P, and then the sector leader trades at a multiple of let's say 75. So we have a sufficient rating opportunity there which gives the margin of safety in the portfolio. So even if let's say 25% of the portfolio companies don't perform as per our thesis, the rest of the companies can double the earnings in double the portfolio earnings in next 3 to 5 year time frame. So to pick out the multi-baggers, we have a RH process in place, investment process in place, where we try to find out the companies from a wide universe of 1900 stocks which are listed on the index. So mainly we start with the screener part where we employ certain parameters like revenue growth, earnings growth, leverage taken by the company, promoter holding, to find out 100 odd companies which satisfy our criteria, and then we try to do a ranking of those 100 companies, taking out some items from the balance sheet, some items from the P&L. So there are like around 25 items that we try to look for, and we try to do a ranking of those companies. So in the radar phase, we try to do a deep dive into those companies. We try to meet with the promoters. We try to make the entire financial statements and forecast the earnings of the companies. And then once we are sure of the company's prospect, we try to assign the weightage in the radar phase. So mainly we set out the guardrails for entry and exit, and also if there are some new disclosures coming from the company or there are some new developments around the policy side, so we go back to our thesis and try to identify the gaps and see if you want to increase the weight or reduce the weight, or take out the company entirely from the portfolio. So this was the process part. Now mainly the entire endeavor for our fund management team is to pick out 20-25 odd stocks which can double the earnings in 3 to 5 year time frame, where the company's promoter is minority investor friendly, and also the company has a clean corporate governance track record. Thank you.
Hi, I'm Vijay Chauhan. So I work as a co-fund manager at RH PMS. So just to give some background on myself, so I have done my BTech from IIT and MBA from IIM. So I have been with the 𝐼𝐻𝐻 since 2018, and I have more than 5 years of experience in the Indian domestic stock market side. So today I'll be discussing on the emerging story framework that we apply in our RH PMS super value strategy. So when we are studying any emerging story from particular industry, so I will just take one example from the paint industry side. So we know that the leader in the paint segment is the Asian Paints Limited, which has more than 15% sales growth in the last 3 years. And if we look at the valuation on the trailing 12 months multiple side, so it's somewhere around 88x PE. But when we are looking for an emerging story who has a potential to be a next Asian Paint, so then we try to look for the company or a business which has a higher sales growth at a reasonable valuation. So one of the company that we track and we have also in a model portfolio is a 𝐶IRCA Paints Limited. So it has a sales growth of around 19% in the last 3 years. And also if we look at the valuation multiple, it is trading around somewhere around 44x PE in the trailing 12 months valuation period. So we understand that the company has a better earnings at a reasonable valuation. So it has a potential to generate higher return versus the industry leader. So when we are looking at this emerging story, so we also try to meet the management and try to deep dive into the some of the competitive advantages which can help to generate better earnings growth and better free cash flow in the going ahead, and it can also translate into the higher share price return, because ultimately share price return is just a reflection of the underlying profit and free cash flow growth. But we also understand the return and risk always comes hand in hand. So when we are looking at the growth in a emerging story, we also look at the some of the risk which are coming from the primarily three sides. So first is the business risk. So we normally don't take businesses which has a low certainty of earnings growth, and we consciously avoid some of the cyclical businesses which don't have a stronger track record of consistently generating the higher earnings growth. Second is the valuation risk. So we don't take a company which is trading at a higher valuation multiple compared to the sector, and we consciously avoid the companies which are trading above margin of safety. And the third is corporate governance risk. So we don't like companies whose management is not shareholder friendly, and also it has very low disclosures. So we try to avoid such kind of companies, and it helps us to avoid some of the pitfalls which can come from our emerging growth story framework. So also we try to avoid companies which have a high promoter pledging, very high leverage, and they have a broken balance sheet, and also the management has not sufficient track record of generating higher return on capital employed. So with this framework of the risk and return hands in hand help us to deliver consistent return over the 3 to 4 years for our investors. And if we look at the one of the business that we took in our portfolio, which was IRCTC in somewhere around 2019. So we studied the business model, and we like the monopoly nature in the online ticket system, and also the low working capital, along with the some of the optionality like expansion of rail near plant and privatization of trains. So when we studied the business, we understood the competitive advantage, and when we were buying the business in 2019, it had a multiple of 35x P in the trailing basis, and somewhere profit around 450 crore. So when we analyzed the business and projected the future cash flow, so we envisioned that the company can generate at least 1600 crore profit by in the next 5 years, and it can command a 1 lakh crore market cap. But fortunately, post the COVID recovery, the business was discovered by the street, and for the earnings compounding, the stock almost re-rated up to the 1 lakh crore market cap, and we took the exit from the business. So this is how we do the entry and exit in advance. Some of the other businesses which have generated phenomenal return for our investors are APL Apollo Tubes, Neogen Chemical, KEA Industry, and many more. So we strongly believe in the India growth story. So if one wants to be the part of this multi-decadal wealth creation journey, RH Super Value can be a good option for you. Thank you.